a.m. in New York City, 9 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. No easing in sight. President Trump threatens further attacks on Iran as Tehran vows to keep Hormuz closed. Brent hovers above $100 a barrel. Round two. The U.S. begins its second trade probes as the Trump administration rushes to construct a new tariff regime. And U.S. Treasury volatility jumps to a 9-month high as the war stokes inflation concerns. That's ahead of PCE data later this morning. So let's take a look at those markets then. Oil, no let-up in sight. Trump warning Iran to watch what happens today. That's certainly not helping. We're just above $100 a barrel on Brent now. Same for WTI, above 95. The whole oil complex repricing conflict risk constantly. Backwardation has steepened, so obviously scarcity is in focus. But conviction is low, and traders do keep remaking their assumptions on how long this conflict is going to last. To that end, look at the 10-year yield. We're right back up to 427 practically. And again, it's across the whole yield curve. We're seeing yields rise and rise. Of course, strains in the private credit industry also weighing on this market too. You'll see the VIX is also starting to pick up for a second day. Let's take a look at futures, because we did see a sort of a mixed session. It's funny because Bitcoin is higher. There's a sort of a risk on and a risk off trade today. Futures have turned lower now. They were higher earlier. And that yen going to be of concern to the BOJ next week. It's trading above 159. Let's take a look at some individual movers this morning as well on the pre-market. Obviously, oil movers once again today. If you take a look at Chevron, Exxon, Occidental, ConocoPhillips, they're all higher off the back of the oil price moving higher and staying higher even after that relief yesterday. Sure, Conoco down just a little bit in the pre-market, but ultimately these share prices are up severely year to date. So Chevron is up 30% year to date, Oxy up 42% year to date, ConocoPhillips also up 28% year to date. Let's take a look at some other movers. Adobe is going to have a tough day post earnings, and of course on the news its CEO Shantanu Narayan will step down after 18 years. It did beat on the top and bottom lines, but some segments, particularly the traditional stock photo segment, really battered by the use of AI generated imagery, and of course it's hovering around multi-year lows. And then Ulta is also lower in the pre-market. It beat on the top line but missed on the bottom line. Profitability is going to be in focus all year this year. Margins taking a big hit. Plenty of questions around the consumer, gas prices, the Iran war and so on going to weigh on this stock, and it definitely was conservative in its outlook. Bloomberg Intelligence also pointing to its wellness push and saying that needs more of an effort. Also coming up in this hour, don't miss our exclusive interview with Daimler Truck CFO Eva Scherer, and we're going to count down to the inflation print with Seema Shah of Principal Asset Management. But first, President Trump threatening Iran with more attacks, posting on Truth Social, quote, "We have unparalleled firepower, unlimited ammunition, and plenty of time. Watch what happens to these deranged scumbags." Let's go to our team coverage now with Bloomberg's Giovanna Bersecci and Anthony DePaula in Dubai. We also have Morena Conium here in studio in London. So, Giovanna, let me start with you. Just where are we in terms of reaction to those comments from the Middle East region and Iran, obviously, in particular?
Yeah, well, we are now day 14 of the Iran war, Bonnie. And yesterday we actually heard from the Supreme Leader, the new Supreme Leader, for the first time since the war began. A statement was read out by a newsreader on state television, and the messaging was one of defiance, once again reiterating that they plan to continue fighting back. Their intention is to keep the strait closed. They are very aware of how much disruption this is causing on international markets, on energy markets, and on shipping markets. At the same time, repeating that U.S. assets in the region will continue to be a target so long as Gulf countries host them. So more of the same messaging coming through in terms of defiance and potential retaliation. And we've always said that for the Iranian regime, this has been an existential fight for their very own existence. And even if the war ended tomorrow, they would probably still deem it a victory so long as the regime itself remains intact. And they've identified that the Strait of Hormuz has become a key choke point for the global economy. On the other side, President Trump saying that He himself is more focused on eradicating Iran's nuclear capabilities than on the price of oil, with oil trading close to $100. Operations are continuing overnight. U.S. and Israeli joint operations have now targeted more than 6,000 sites across Tehran, and Iran continues to fight back as well. I will say just in the last 12 hours, there's been slightly lower level of attacks taking place around the Persian Gulf, but that's not to say that they have stopped. We have heard of drone interceptions taking place in Saudi Arabia. Here in the UAE, in Dubai, also drone interceptions caused a limited damage around central Dubai. And then ongoing also interceptions above the Kuwait airport. And so they're still targeting very strategic assets around the region. And as you can see, the language from both sides appears to be one of, we're going to keep going with this war.
Anthony, let me come to you. Our Bloomberg opinion columnist Javier Blas saying, look, the administration is running out of options for bringing down, gas prices, essentially oil prices, obviously, too. And Halima Croft of RBC saying today that after some conversations in Washington, D.C., she now thinks that the price could go up to highs that we haven't seen since the Russia-Ukraine war. So that would be $128 per barrel. And that could happen just very soon, because she now thinks that we're going to see another 3 to 4 weeks of this. What is the market telling us with Brent above $100 a barrel, even after all those release announcements?
Hi, Bonnie. Yeah, good morning. Well, we are hearing, that maybe that 100 isn't enough. That release announcement of 400 million barrels a day was a big number, meant to kind of underpin confidence in the market that consuming countries were taking action, were doing what they could do to soften the blow here to the economy. In terms of options that either Trump has or that the IEA member states have, I mean, these are options that are kind of like Band-Aids or minor solutions to a bigger part of the problem, and that's Hormuz. So without the Strait of Hormuz being reopened and that massive amount of oil being able to flow out of the Persian Gulf, we're not going to find an easy resolution to this problem. And the longer that stays shut, the more potential there is for fields to have some longer-term damage, or potential for it to take longer to start things back up. So the longer we stretch it out, kind of the longer the knock-on impacts will take place. And again, these measures like releasing oil, it's a matter of flow. In terms of the IEA release and the member countries like the U.S., Japan, European countries that will release oil, they can't do it at a rate fast enough to replace what we're missing from the Persian Gulf producers. These are some of the biggest producers there: Saudi Arabia, the United Arab Emirates, Iraq, Iran itself. Production is down there, and oil is shut in. So that's a real problem for the market, Vonnie.
And Morwen Iconium, I want to come to you and talk to you about the Treasury situation, because the MOVE index obviously spiking, and Treasuries are also really reflecting this fear. It's definitely not a safety trade.
No, absolutely. I think that inflation concern is being reflected in bonds all around the world. It's being seen in Treasuries as traders are paring their bets on interest rate cuts from the Fed. I think what's also particularly interesting is that Trump has renewed his calls for Jerome Powell to cut interest rates. So I think that really adds to the sense of volatility and risk in the Treasury market at the moment.
Yeah, at no meeting is a full rate cut now priced in for this year. The first time there's a full rate cut priced in is the middle of next year. I have to thank you all. Morwen Iconium here in studio, also Jemana Bersachi in Dubai, and Anthony De Paula also in Dubai. Turning to trade now, the Trump administration is starting its second round of tariff investigations, this on 60 economies, as it attempts to rebuild its agenda after being struck down by the Supreme Court. Joining us now is Bloomberg's Laura Davison. Laura, assuming that these investigations go as quickly as possible, when might we see actual tariffs being placed on countries?
This could be a process that takes weeks, if not months, but they could move very quickly. The Trump administration is really taking a maximalist approach here as they're looking at these trade investigations that are essentially a precursor for new tariffs. This is the second round this week. One that was announced on Wednesday was looking at overcapacity from trading partners, including China and other top trading partners. The one that announced on Thursday is specifically looking into forced labor practices. Basically, this is sort of the result of of the Supreme Court striking down those tariffs several weeks ago, saying that the Trump administration just can't unilaterally put this on. They have to kind of build the case and say why there's a need for tariffs against these trading partners. The risk here for the Trump administration, though, is that if they move too quickly, if they don't make the case, they don't put in the research, they don't do the work, that these could also face legal challenges going forward and be struck down by a court in the coming months or years.
China already today, the Ministry of Finance coming out and saying this is against WTO rules. But of course, the Trump administration doesn't particularly subscribe to WTO rules in the first place, does it, Laura?
No, they do not. This is, been heavily criticized from a lot of different trading partners. Also seeing reports that India, for example, is looking to delay any trade deal just as all of these various moving pieces shake out. The strategy that the Trump administration had really employed during its first term of sort of a move fast, impose tariffs, being willing to threaten them and then pull them back. That's no longer really the name of the game. It's a much more slow prodding process, much more targeted tariffs, and it's going to be a more difficult situation for Trump to get those tariff rates up high. That's not to say he doesn't have any tools in his toolbook, but kind of exposing what we saw from the Supreme Court just a couple weeks ago, exposing those cracks in the strategy that Trump may not have quite the expansive power when it comes to tariffs as he sort of indicated trading partners that he does.
Laura, thank you so much for all the context. That is Bloomberg's Laura Davison. Coming up, our exclusive interview with Daimler Truck CFO Eva Scherer on the company's plan to offset tariff expenses. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in London. Shares of Daimler are down after gaining following a robust earnings result. The firm said it's banking on stronger sales and planning for deeper cost cuts to counter rising tariff expenses. Joining us now for an exclusive interview is CFO Eva Scherer. Eva, thanks so much for joining. First to the tariffs. How are they impacting Daimler's truck business? How are you even keeping track and accounting for the costs?
Yes, hi, Ivani. Thanks for having me. Happy to be with you. So when we look at last year, what really impacted our result in North America was also the market downturn and the longest freight recession in recent history that we were facing. And we had a 25% reduction in unit sales year over year. And despite that, we were actually able to come in with a return on sales adjusted of 10.7%. We also had a tariff effect of about 250 million euros net. If I would deduct that, we would have even ended the year at 12% profitability in North America. So we have navigated the situation quite well because we have adopted very quickly to this changing volume environment, which was the biggest impact. We adjusted our cost structure. We also made adjustments to our workforce. We also reacted with pricing measures and, of course, focused on delivering value to our customers. And flexibility is really key in that environment. So our highly flexible production footprint helps us to navigate that.
Well, Eva, obviously the conflict in Iran is on the radar now too. You have that to deal with. You're not in the Middle East per se, but there will be all sorts of knock-on effects. What will be the major ones for Daimler, and how do you plan to deal with rising fuel prices, potential disruption to freight and so on?
Absolutely. So maybe about the Middle East first. So from a business perspective, it's only 1 to 2% of our global revenues with the Mercedes-Benz Trucks brand. But obviously, first and foremost, the safety of our people in the region is most important to us. And then we're closely monitoring the impacts on supply chain and logistics. And as you mentioned, the biggest risk we see if this crisis prolongs is really the impact on the macroeconomic environment, because we have actually ended last year with a very positive order momentum in Europe and in North America, our two most important markets where we also are number one in the truck market. And we obviously do hope that this positive momentum continues. We do very closely look at fuel prices. That is a significant portion of the operating costs of our customers. At the moment, we do see the positive order momentum continuing, and we obviously have to see how this situation progresses.
Well, you obviously have a significant military trucks business as well. I'm curious how you plan on taking advantage of certain situations in order to maybe increase that business.
Yes, so in Europe, we do see that the business development has been moving into a positive direction in the second half of last year after a weak environment for the last 1 to 2 years. We have been actually hoping that the macroeconomic situation in Germany would pick up quicker, fueled by infrastructure spending and also defense spending that was announced by the new administration about a year ago. We do not really see that in our orders momentum yet in Germany, but we have seen orders being a bit better in recent weeks, and we do hope that it will pick up because Germany represents a big market for us. We have about double the market share in Germany than in the rest of Europe. In Europe, we have about 17.7% in medium and heavy duty. And we do see a good development of our defense business overall. We have won a tender with the French army delivering 7,000 Cetros vehicles together with Arcus. So we believe we're well positioned also for defense growth because we focus on logistics vehicles there. And as one of the largest truck manufacturers in the world, we know how to scale production quickly because we really know how to manage a cyclical business. And we do have a great service and parts networks available that helps also in this market.
Well, speaking of production, Eva, are you in any talks with the U.S. administration on maybe expanding production, perhaps even, an investment in the United States or maybe even a plant?
We are in constructive discussions with the U.S. administration. We have a strong American footprint. We are the market leader in Class 8 trucks in North America with 39.6% market share last year. We do have 7 production sites in the U.S., and we constantly invest into them. We have also applied for preferential tariff treatment, basically acknowledging the U.S. content that we also have in our trucks that we assemble in Mexico. And we are positive that that will help us also to reduce the tariff burden. So we are increasing our U.S. content there and, of course, constantly looking at how we also keep strengthening our U.S. manufacturing.
Eva, the shift to electric trucks, how is it going? On the one hand, you have China, in your rearview mirror, they're trying to catch up with you. On the other hand, in some areas of the global economy, the electric market isn't a priority anymore.
Yes, in the U.S., we do believe it will be diesel for longer. We're well positioned there because we do have the largest heavy-duty powertrain in the world in unit sales per year. So we are investing also in the next generation of efficiency for our diesel powertrain. But in Europe, the zero-emission transformation is going a bit faster than in other parts of the world. And I'm happy to report that we do have the most successful heavy-duty on-highway truck there in the market, the e-Actros 600. We have a market share as of Q4 last year for the full year of around 40%, but 50% in the fourth quarter, so a positive trend. We take Chinese competition very seriously, but we believe with our battery technology, we're using LFP battery technology and a high efficiency level. We can deliver value to our customers and, of course, also building on our strong infrastructure, spare parts and service network in Europe.
Eva, growth in India was one of your strategic goals. Is that now a little bit on pause, given how the country is basically suffering plenty of secondary effects from the war?
In India, you're talking about India, right?
Yes.
Yes, I was just wanting to make sure that I heard you correctly. So in India, yes, it's one of our growth markets. And we do see generally also a positive market momentum there for our Bharat-Benz products. For us, India is really a strategy that goes into 2 directions because we're using India also as an engineering and IT hub for the whole world and also a manufacturing hub for various other countries. So we also have a local for global business there, which is important for us to deliver also really cost-effective trucks to price-sensitive regions, and then also, of course, with our strong Bharat-Benz brand for the Indian domestic market.
Eva, pleasure to speak with you. Thank you so much. Hopefully next quarter again. That is Eva Scherer of Daimler Truck. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in London. Time now for your front page news. First up on the New York Times, Meta delaying the rollout of a new AI model after performance concerns. The Times reports the model, codenamed Avocado, has fallen short of competitors from Google, OpenAI and Anthropic on internal tests for reasoning, coding and writing. Next up, the Wall Street Journal reporting ByteDance is assembling computing power with high-end NVIDIA chips outside China to fuel its AI ambitions. The Journal reports ByteDance is working with Southeast Asian company Aolani Cloud on plans to use Blackwell computing systems in Malaysia. And finally, on the Financial Times' front page, Carlyle overhauling its European private equity fund due to poor performance. The FT says Carlyle has hired 9 people to the fund last year and expects to recruit 2 more. The FT says it's a sign the firm has recommitted to Europe after a period of turbulence. Let's check out those markets now going into this Friday the 13th. As you can see, S&P futures are pointed marginally lower. The VIX has now flipped. It is in negative territory. That 10-year yield, though, topping 4.27. Coming up, we'll push ahead to PCE. It's 5:30 a.m. in New York City, 9:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. No easing in sight. President Trump threatens further attacks on Iran as Tehran vows to keep Hormuz closed. Brent hovering above $100 a barrel. Round 2, the U.S. begins its second trade probe as the Trump administration rushes to construct a new tariff regime. And U.S. Treasury volatility jumping to a 9-month high as the war stokes inflation concerns. That's ahead of PCE data later this morning. Let's take a look at Brent now because we are just off our highs of the day, but nevertheless, we're still above $101. New York crude above 95. That 10-year yield is creeping ever higher as the morning goes on. No let up in sight for the whole oil complex, actually, as traders continue to reprice this on an hourly basis, it would seem. In terms of equity index futures, we've been both. We've been higher, we've been lower all morning. Right now, pointed to a very marginal lower opening. But don't forget, we're not that far off our records. 4.4% for the S&P, 6.4% for the NASDAQ. And then the yen, well, that's telling a big story there, 159.34. Continued dollar strength causing headaches for many central banks around the world. Some stocks to watch then. Obviously, we're watching the oil majors. They continue to do well this year on higher prices. Many of them higher in the pre-market and many of them up 30 to 42% in the case of Oxy year to date. Then let's get to Ulta Beauty because that's also lower. And Adobe first. I just want to point out Adobe is down more than 8% actually after a big earnings quarter. It had a beat on the top and bottom line. But the CEO, Shantanu Narayan, will step down after 18 years. And there are a lot of questions surrounding the use of AI in general, particularly the stock photo segment that was really battered by AI generated imagery. And of course, annual recurring revenue also a little bit lower. So growth not as quick for Adobe as it has been in the past. And then back to Ulta again, because that is lower again. It missed on the bottom line, in fact. Profitability is going to be a key question this year, although it does continue to grow. It needs baskets to be bigger and it needs the U.S. consumer to hold up. But will the U.S. consumer hold up if gas prices continue to rise? We shall see. Just under 3 hours to that January PCE data. Joining us now is Seema Shah of Principal Asset Management. So many questions, Seema, difficult to know where to begin, but we have to start with oil. Helene McCroft of RBC saying this is going to go on for a few more weeks at the very least. She's more convinced of that, having had discussions in Washington, D.C. What are your thoughts? What's your base case?
Thanks for having me on, Bonnie. Well, look, so our base case, I think it has to be this is going to be somewhat short-lived, that you see oil prices stabilizing around the $90 mark and then coming back down again. But I have to say there's very little confidence about that. And what's been interesting about certainly what Halima had said is that downside scenario, the very severe case, has really shifted. It's really shifted in a more negative way in the past week. So just a week ago, people were talking about a worst-case scenario of about $100 to $120 a barrel for a couple of weeks. That severe scenario has now shifted to numbers like 150. I've even seen some for 200. And so the equity market response, although it's been negative, it's been quite muted. And to me, that does suggest there's maybe a little bit of complacency, some vulnerability for the market in the next few weeks.
So we do see the VIX spiking every now and then, but then it sort of comes back. And as I say, we're really not that far off our records. Is the US stock market more focused on things like private credit concerns, software concerns, or will it at some point price in a worse outcome to this war?
Well, I think the market has been conditioned to believe that geopolitical crises are typically very short-lived, and that has always been the case unless it starts to really hit fundamentals, and obviously oil prices are really key here. The other thing the equity market is focusing on is the idea that because of affordability pressures in a midterm election year, President Trump is likely to back down at some point, call victory and bring this to an end. And then whenever that happens, there is a fairly good chance that you see a snapback in oil prices and the market, resumes its upward trend. So I think the equity market is a little bit averse to changing positions significantly and responding to this. But this is a real contrast to what you're seeing from the bond market, where the bond market is more concerned that this is going to be a sustained crisis where you see oil prices remaining over $100 a barrel for a while, and then that feeding through to inflation. So there is a real contrast between equities and bonds right now.
Well, and the problem is, at some point, it's just broken, right? You can't reel something back in. And, according to Jeff Curry, it's already happened. There is no policy response to oil above $100 a barrel. But you do see mechanisms whereby we could see oil come back to the 80, maybe 70, maybe even back to 65 where it was before all this pretty soon?
So there's always a possibility that this does come to an end. We know that from before that, this could come to an end as quickly as it started. Certainly, as the days are going by, the risks are increasing that this is going to be a more protracted conflict. And the other thing that we're seeing is that as you see a number of the production facilities come to a halt, energy infrastructure, some parts of it being damaged, it's going to take much longer to get things moving once this conflict, whatever that is, comes to an end. So from that regard, actually having oil prices sustained at a high level, they may come back down again a bit, but actually having them sustained at a higher level is becoming a greater likelihood.
There's at least 10 central banks meeting next week. The ECB, the BOJ, the Fed, the Bank of England, all the big ones and many smaller ones. Will a rate hike be on the table for any of them? Maybe not this coming week, but in the very near future?
So it's certainly possible. This is kind of the worst nightmare for central banks because it creates such a dilemma with price stability moving in such a different direction to what you see for economic growth. Now, typically what we would expect to see is central banks look through the price increase, at least in the near term. They want to look through it for the same reasons that we were saying before, that it could come to an end pretty quickly and then there's not really any discernible impact from a long-term perspective. Of course, the longer this goes, it's more difficult to ignore. And remember, inflation has been above target for about 5 years now. So I think the hurdle for shifting to a more hawkish response is that much lower. Certainly for us, we see a greater likelihood of hikes in the UK than we do in the US, partly because there's a stickier inflation problem in the UK. For the Fed, we came into this year expecting 2 rate cuts in the second half of the year. If things really progress in a very negative way, we would probably take those rate cuts off the forecast. I think for the US, maybe shifting to rate hikes is a little bit more challenging, but certainly it's an easier thing to see for the ECB and the Bank of England.
Right. Well, at the moment, there are no interest rate cuts priced in anymore for the Federal Reserve, at least. But that's going to actually cause problems, right? If Donald Trump's still calling for a cut, and we know that there's really not much of a consensus on the FOMC board right now. So what is next week's meeting going to look like?
So I think next week's meeting is going to be I think they'll stick to the script in terms of just looking and noting that inflation pressures are still there. They're still very much present, although they have been maybe declining in some regard. But the labour market also is showing some concerning signs of weakness. So, the real interesting part is going to be for Jerome Powell, what happens in the press conference, what are the questions that he's going to be asked. And I think what they're likely to do is, let's say, at this stage, the Federal Reserve almost has to look through a supply-driven
He cannot bring back the word transitory. He cannot.
We'd hope not. But I think also alluding to the idea that they have to keep an eye on it. So if this were to be sustained, then this creates, a bigger dilemma for central banks, and not just for the Fed, as we said, but for so many central banks around the world.
Seema, we have to leave it there, but wonderful to speak to you and have you in person here in London. That is Seema Shah of Principal Asset Management. Now, let's take a deeper look at oil in Dubai with Bloomberg's Anthony De Paula. So, Anthony, we continue to see nothing much changing when it comes to maritime safety. Promises of tanker escorts, and we may even be seeing mines laid. What is the latest from the region that we know for sure?
Well, Vonnie, hi. Good morning. Yeah, I mean, the only thing we know for sure is that Hormuz remains closed. And that's pushing oil up to around that $100 a barrel level. And interesting to hear the comments from your guest there, Seema, talking about the potential, the potential for oil to go even higher if the market has become a little bit desensitized to some of these risks, perhaps is looking for a quick end to the crisis in the Gulf and the closure of Hormuz. But we have heard some comments recently, as recently as yesterday, even from U.S. Energy Secretary Wright, talking about a number of weeks for the continued closure. So that's a risk. And we have heard that the longer it goes on, the more risk there is for equipment or oil fields that are shut down to have some potential damage because oil fields can lose pressure. It becomes more difficult to bring them back. And so that is a longer kind of ramp up to get us back to where we were before. Plus, let's not forget that energy infrastructure continues to be targeted. We haven't seen any major damage yet, but that remains a risk. And that seems to feed into some of the complacency that we are seeing in the market, that we haven't yet seen any facilities or fields damaged that would impede their coming back if the Hormuz does reopen. But at the moment, we just don't have that. We don't have that access to a major quantity of oil that's needed in the global markets, Vonnie.
Anthony, the Trump administration seems to think that there are some mechanisms by which it can open the Strait of Hormuz, right, or make sure that ships start to flow through. But is there any open strait without Iran's say-so?
Well, this has always been a kind of a subject of military hypothesis, of gaming things out. And the thought has always been that the U.S. Navy would be able to open Hormuz only after a few hours or maximum a few days. But now we are seeing that with really little expenditure of hardware from the Iranian side, it's more the threat of hitting vessels going through Hormuz that has stopped the vessels from going. So vessels have seen a danger there. Clearly, we have seen a number of vessels hit, even in the early days of the conflict, in and around the Hormuz area, but really not vessels that were actively transiting. And since then, we have seen vessels hit all across the Gulf. So owners, shippers, traders are seeing the risk there, and they're saying, look, we're not going to go through. It's too risky. There is too much of a risk, and they're just not going to take that. So without a major, say, flotilla of vessels, without obviously mining the straits. We have heard discussion about that, and some assessments from the U.S. and U.K. military have been reported that there may be mines there. But without real clarity of what Iran's doing, they've been able to shut the strait with some missiles, some ship mines, some small vessels approaching other vessels, and that's had enough of an effect to really chill anybody's desire to cross through there, and that's really choked off all the transit. So it doesn't seem that there's an easy solution to getting that reopened, at least not while the conflict is ongoing, Vonnie.
No. Anthony, thank you so much. A fantastic context there from Bloomberg's Anthony De Paula. Now to other top stories trending on the terminal this morning. The UK economy unexpectedly stalled in January. GDP was unchanged after going 0.1% the previous month. Economists forecast 0.2% for GDP growth. The services sector stagnated. Manufacturing and construction grew just slightly. Hong Kong is cracking down on sloppy listing applications, expanding its, quote, name and shame regime. Under a new proposal, all professional parties involved in a deal that includes law firms and auditors too will be publicly identified if an application is rejected for not being substantially complete. The plan aims to improve the quality of IPOs in the city. Hollywood enters Oscars weekend as the film industry experiences a crisis. The industry is facing tens of thousands of layoffs, declining attendance at theaters, and fears that AI will displace traditional movie making. The Academy of Motion Picture Arts and Sciences will hand out its highest awards to films and filmmakers this Sunday. Coming up, more trade probes. More on the Trump administration's continued efforts to revive its tariff agenda. This is Bloomberg. This is Bloomberg Brief. You're looking live at the Principal Room. Coming up on Open Interest, an interview with Michael O'Sullivan, Burlington CEO. That's at 10:30 a.m. New York time, 2:30 p.m. in London. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in London. U.S. Trade Representative Jemison Greer initiating a second round of trade probes, this time into 60 economies. Whether the Labour Act's policies and practices are unreasonable or discriminatory in question. And, of course, the burden on U.S. commerce is also under question. Joining us now from Washington is Jonathan Tamari of Bloomberg Government. 60 economies, Jonathan. I mean, how quickly can these investigations proceed?
So the goal of the administration is to have these wrapped up sometime in July, which is when the current tariffs that the president has imposed after the Supreme Court decision will expire. They're basically trying to piece back together the regime that was struck down by the Supreme Court. These temporary tariffs can last for a few more months without approval from Congress, and the idea is that these investigations will then lead to additional tariffs that replace the temporary ones that are in place right now.
So, Jonathan, it could be several months, right? We may not see these tariffs go on till at least the summertime.
That's right. But in the meantime, the president does have some temporary powers that he has reimposed tariffs for. So the investigation will play out for a few months. But again, the idea from the administration is that they're going to have one set roll off and have another set roll on because the original tariffs that the president imposed were wiped out. But he's certainly not backing away from the idea that he's imposing widespread tariffs on these many different countries, just trying to find different mechanisms to do it now that his original method was deemed illegal.
Just on Iran, Jonathan, the Trump administration and President Trump himself warning Iran to watch what happens next. We're already hitting the 2-week mark. Does he have a plan to, at some point, maybe bring this to a conclusion?
That's been the biggest question since this all began. And if you listen to his rhetoric, it's changed from day to day, sometimes from hour to hour, about this being very close to an end, or maybe no, we can go as long as we want and we can go a long time if we need to. At times he might say, we've already accomplished all our objectives. And at other times he might say, no, there's still a lot that we're still trying to achieve. So it's unclear exactly what the end game here is, what the goalposts are, what he wants to see happen to decide that the U.S. has achieved enough and can end these hostilities. So I don't think we have a lot of clarity, and it can change from hour to hour, to be honest.
Yeah. The Treasury has given the green light for the sale of more Russian oil, but it's just Russian oil that's already on sea, right, Jonathan? The Treasury Secretary saying it's not going to fill up Russian coffers, but it can't hurt.
Right. It shows how this conflict in Iran is running, at cross currents to some of the other administration priorities, including applying that pressure on Russia to end the war in Ukraine. It is a short-term waiver. It's going to apply for about a month. Analysts say it's not going to make a humongous dent in the market. Maybe a few days worth of oil exports that are being lost could be replaced. So it's not a massive change, but it does show the tension in the administration's policies. And as you point out, it'll help Russia at least somewhat with some of its oil sales.
All right, Jonathan, thank you so much. Jonathan Tamari of Bloomberg Government. I do want to mention as well, we're just getting confirmation that 4 have been confirmed deceased in the loss of that refueling aircraft, the KC-135, over Iraq. Again, 4 confirmed deceased in that refueling aircraft. Now, the U.S. says it's still investigating the incident, and the terms of the incident, the circumstances are under probe. Again, reiterating it was not hostile nor friendly fire. One stock we're keeping an eye on, Adobe. Shares extending their slump after the CEO announcing his plans to resign after 18 years on the post amid investor concerns over the firm's ability to perform well in the AI era. Joining us now is Bloomberg's Tom McKenzie. Difficult for Adobe this quarter.
Yeah, look, Adobe... The backdrop is Adobe's been the kind of poster child of scrutiny over a software company that will need to adapt to this new AI world, and investor questions as to whether or not they are moving quickly enough in terms of embedding AI solutions and how vulnerable they are, how defensible that business is. This quarter results were actually pretty solid. They continued to hold their forecast for the year. Margins actually improved. AI monetization actually improved. But the big headline was that the CEO, after 18 years at the helm, would be stepping down. And this is Shantanu Narayan. And Citi analysts put out a note saying that the stepping down of the CEO at this point, quote, adds another layer of uncertainty at a delicate moment in the story. Let me give some detail on that story, because I've been speaking to the CEO of Lovable. It's a vibe coding platform. It's a platform that allows you or I or anyone who doesn't have coding skills to build an app, build a website. And this is exactly the kind of company that investors point to in terms of the potential disruption of some of the legacy names like Adobe. Take a listen to what the CEO of Lovable had to say.
I don't think they're going to die. I think many of them might innovate, which is usually what happens under pressure, and that's naturally a good thing, right? The competition and changes make companies evolve, innovate, and create more value in the end. How much of that they can capture in terms of profit, if they do innovate through this phase, remains uncertain. I would not be surprised if the amount of profits from these companies continues to decline.
I wouldn't be surprised if the amount of profits for these companies continues to decline. To be clear, Adobe has not seen a decline of profits. Its earnings were stable, but it is part of that SaaSpocalypse story and scrutiny and concern for investors. And now you have change at the top of the CEO. With the CEO. And that was just the view of one of the key disruptors in this space from Lovable.
Yeah, and I mean, he steered the company for 18 years, a long time, Tom. Meta is also delaying the rollout of something, surprise, surprise, right? When has that happened at Meta before? Just kidding.
Yeah, so Mark Zuckerberg, he's still not winning in terms of building foundational and frontier models in terms of AI, despite how much he spent on talent. And despite the fact that he invested over $14 billion in scale AI, despite the fact he took on this wunderkid, Alexander Wang, to take over and lead the AI prospects for them. They were meant to come out with the latest model in March. The New York Times is reporting that that's now going to be delayed until May because they are not yet competing and getting up to the same level as Gemini of Alphabet, of course, of OpenAI. So delayed. Interestingly, from the New York Times report as well, suggestions that Meta's even considered licensing Gemini AI to power Meta's own AI products. That sounds like a pretty desperate move. They haven't got there yet, but the fact that they've even discussed that, according to the reporting, will be a red flag for many. Others say, look, Meta has time to catch up. They are still producing foundation models, including this one, that will be pretty significant. It's just not up there with the best of them yet. So it's a challenge for Meta and Mark, given how much they've spent, and the commitments around $135 billion of capex just this year alone.
Wow, and it was supposed to come out this month, and now it's going to be at least May. All right. Tom McKenzie, thank you so much. And on the next episode of Tom's Bloomberg Tech Europe, Tom's going to take a deep dive into the chipmaker ARM. You can catch that episode on April 10th, right here on Bloomberg TV. You can also watch it on the terminal and on YouTube.com, as well as at our video hub. That's at Bloomberg.com/video. This is Bloomberg. A quick programming note. Because of daylight savings time, we're going to be back on Brief on March 30th. That's it for Bloomberg Brief. Surveillance is next.